It's live with the mortgage calculator. Today we're going to be talking about fix and flip loans. Great topic. Everybody loves fix and flips. Everybody wants to do them. So we'll talk about the benefits and limitations of doing those here in a little bit. But what we'll do first is we'll go over the daily rates. Going to be a very interesting show today with the news that's been going on. There's definitely been some dropping in the rates. So we'll check it out here today. We do wait just a minute here, though, to get started. Let us go live on all the different platforms. We put the chat up on the screen, so feel free to drop a comment there in the chat as you tune in. We appreciate everybody already dropping comments there, tuning in nice and early. Appreciate it. All right. Good morning. Good morning. Michael, great morning. Thankful Thursday. I think Michael has a name for every day. Taco Tuesday, Thankful Thursday. I like it. Great positivity every morning. All right. Good morning. Morning. Grand Rising. Good morning. All right. So it looks like we're live on all the different platforms. So let's go ahead and get it started. We'll take the chat off the screen, but keep dropping comments there. Drop any questions you have as well. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We're a correspondent lender, and we specialize in non-QM loans. And what we do every morning on this show is go through some live mortgage rates. And then we do a deep dive into a different topic every day. Today's topic is going to be fix and flip loans, one of our specialties here at the Mortgage Calculator, because we do a lot of we work with a lot of investors. So Jose, our sales manager with 28 years of experience, is going to do a deep dive into fix and flip loans. But before we do that, let's do what we do every morning, which is pull up the rates. Definitely an exciting day to pull them up. So Nick, if you're ready, let's pull up our pricing tool and see what the rates are looking like this morning. Our rates are definitely smoking.
Oh yes, today will be a good day. Let me go ahead and change my screen and we will check it out. The recent Fed news definitely have the markets in our favor, and we love saving our customers money. So today we will definitely see some good action here. So what we will do here with our pricing tool, we will check out the general rates and the APR today. It is December 14th, the day after the Fed announcement again. So a lot of movement in the rates throughout yesterday and today. Will be substantially lower than yesterday. If you'd like a full breakdown of all of the fees that go into the APR there, the full loan estimate, please get with our team members. We have over 400 licensed loan officers in 24 states. So to compare the rates as we do every morning, we'll set up a basic scenario to compare across the programs. We'll set a loan amount of $400,000. We'll set the LTV to 80% loan, 20% down payment. And we'll set the desired price so that we can find the absolute lowest rates for conforming conventional. Then we'll compare that with FHA. Then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional programs. We also have VA and USDA. The rates are definitely dropping there as well. VA is only for active service members and veterans that are eligible. If you are, just let us know. And USDA is only for eligible properties. So if you do happen to be looking at one of those areas, just let us know. We'll start with conforming conventional here. We'll do a purchase, 30-year fixed, standard loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos here, we'll use an estimated credit score of 760 and an estimated debt-to-income ratio here of 40. So let's check out the rates this morning. All right, we got some good action already. I expect once some more rate sheets come out, it'll be even lower. So definitely a little bit lower than it was already yesterday, and it will continue hopefully to move down. 6.25 right here, 2.25 discount points at cost, puts the final APR at 6.519, which is quite a bit lower than yesterday. I believe it was 6.7 something, 6.8 almost. And if our customer doesn't qualify for a conventional program for any reason, typically the next option we want to check out is an FHA program. So we'll set up the same exact scenario, and this time we will compare FHA, which allows a little more leniency on credit issues, as well as a much higher debt-to-income ratio. However, for the demo, everything else will stay exactly the same, so we can compare apples to apples here and compare the APR. So best option here at the top, 5.5 rate, 2.25 discount points in cost, puts the final APR at 6.416. Again, just a touch cheaper than conventional here if our customer qualifies for both, which has typically been the case with the recent changes. Remember, this APR does include the upfront and yearly mortgage insurance for FHA. So this is a great deal for our customers that must use the FHA, and even some of our customers that qualify for both. Definitely don't overlook it. Now, where we live to specialize is if for any reason our customer doesn't qualify for FHA or conventional. Many other banks or lenders would have to deny that customer. But fortunately, we have over 5,000 additional options here under expanded guidelines, also known as non-QM. So we'll keep everything else the same. However, with non-QM, we can select a new income option. So full doc is what we use for conventional and FHA. That means 2 years of tax returns, what most people are used to. So typically we'll choose a non-QM option to take advantage of one of these alternatives. We have asset-related programs, business bank statement programs. For investment properties, we have a couple specialty programs we'll show in a minute. We have our personal bank statement 12-month program, which is what we use for the demo. That's the most popular. We'll also have RSU, stated income, VOE, 1099, P&L, no income CDFI, all kinds of options, and we do episodes on all those options as well. For the demo, we always use the 12-month bank statement, and that's for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years of tax returns, may have various write-offs and may need a little help qualifying, or just may need a little bit of extra income to get that home they really want. We will solve that problem, no tax returns at all, just their last 12 bank statements, to determine a debt-to-income ratio of 40% in our example here, using just the cash in the bank, no tax returns at all. And therefore, our self-employed borrowers usually qualify for much more income and can therefore get the home they really want. So let's check out the bank statement options this morning. Whew, quite a big jump there. That's even more than conventional. So yesterday, this was over 8 on the APR. Today, we have option 7.25 rate, 2.5 discount points in costs. Puts the final APR at 7.678. So that's almost half a point lower than it was yesterday. That's amazing. And again, very comparable to conventional for our customers that need to use a little bit of extra help for a little bit more income and use these programs. They're definitely very comparable. And if we scroll down here, there's hundreds of variations. Some of these at a little bit higher rates and costs may allow bankruptcies, foreclosures, other types of credit events. And some may allow us to use different methods to calculate the bank statement income. Not all programs are equal here, so find the best one by getting with one of our team members. And before we get into Jose's example, we want to do some live pricing for investment properties. So we love to work with investors, first-time investors, seasoned investors. We have some cool options here. So we'll set up the same demo here, 400,000 loan amount, 80% loan to value, 20% down payment. And we'll compare our options for investment properties for conforming conventional and our non-QM expanded guideline options. Government programs like FHA, VA, and USDA do not work for investors. So we'll compare these two. We'll start with conforming conventional. Everything will stay the same. All we've edited here is the occupancy to investment. So we can check out the adjustments for investment. Wow, that's a pretty big difference there. 6.624 rate, 3.375 discount points and cost, puts the final APR at 7.018. I believe yesterday this was almost 7.5 for the investor version of the conventional. So definitely some very good options here. Just a month or so ago, these were almost non-existent. Now there's definitely some good options. So for our customers that qualify full doc, definitely check out the conventional options as the rates come down. And we always want to compare an investment option for non-QM as well. So we'll set up the same demo again. And this time we'll choose expanded guidelines, also known as non-QM. And the first thing we need to select is our income type for an investment property. The most popular type is the DSCR. That's our most popular loan by far because it doesn't actually require any income or employment info from the borrower. We simply use the estimated rental income from the appraisal to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage, aka the property cash flows monthly, that's a ratio of 1 or higher. We have options for properties that don't quite cash flow under 1 ratio. For the demo, we always use 1.5, which will show all the different programs. And finally, we must select a prepayment penalty for a non-QM investment property. 3 years is standard for these programs, so that's what we'll use for the demo. We can select 0, which will limit what shows up and cost more. We could also select 5, which will again limit what shows up, but does save our customers some money if they're going to hold the property. 3 years is standard, so that's what we select so we can see the most common options pop up. So let's check out the DSCR rates this morning. Wow! Back in 7. Who knows, maybe later today we see it go even lower. 7% rate flat, 3.25 discount points in cost. Final APR 7.499. So some great movement there on this program. I expect some of these other programs to reissue rates later today and maybe tomorrow and be even lower as well. So some amazing options here for DSCR and almost identical to conventional, by the way. And if we scroll down, there's tons of different options for DSCR. Some of these at higher rates and costs, again, may allow bankruptcies, foreclosures, other issues. Some may allow different types of income calculation, short-term rental income, very popular requests these days. And to segue into our topic for today, some of them may allow different seasoning, which we talked about earlier, which goes right into the topic for today for our fix and flip loans. So we definitely have some, got a typo there. Definitely have some good options for our investors to get into a property under a fix and flip loan where the property would otherwise need to be purchased with cash and renovate the property to whatever standard we need to renovate it. Hopefully rent the property or get it rent ready and then refinance into a permanent loan, a term loan, which is typically the DSCR that we just went over. So DSCR, very popular. Of course, most investors that are working on a project where the property may have condition issues and maybe needs to be brought up to code, they would need a fix and flip loan to then get ready for a DSCR loan for the permanent loan. So DSCR that we just went over, most popular takeout method after the fix and flip, but a lot of investors need that fix and flip help. So Jose, if you're ready, let's go over how we can get these investors into a fix and flip program.
All right. Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. We definitely love using these fixed flip loans as one of the instruments that we offer to our investors. Obviously, what follows the fixed flip loan, if the investor wants to keep the property as a rental, is the DSCR loans that Nick just went over. Makes it a lot easier when those investors own multiple properties, especially taking a whole bunch of write-offs. The DSCR loans tends to be the more viable option. However, that does not mean that we do not offer the lowest cost option, because if there is a lower cost option than the DSCR, that is the one that we would offer. But those DSCR loans rates are smoking. The other thing to consider when this overall strategy for the investors is seasoning on title, right? We have DSCR loans where you can do a cash out refi with 0 months seasoning on title. On title today, you can refinance tomorrow with a cash out refi and get the market value versus a purchase price. Now, obviously, that wouldn't be the scenario usually for the rehabber who's going to need to rehab the property. That's going to take some time. But it's what's very exciting for them is they love the options that we have. We have an option with no seasoning. We have an option with 3 months seasoning. And then we have an option with 6 months seasoning, which is more the standard. And then there's a couple of options out there with 12 months seasoning. But obviously, those aren't the ones that they usually select. Let me share some options here with you right now. Biggest thing to consider when you do have the fixed flip loan is the experience level of the flipper, right? Because that's, if they have 0, that's going to determine if they're even going to be able to do it, because considerations are experience level, the profit in the deal. The profit in the deal essentially is the income. That's how they're going to view income. And then credit report. So 3 major components there: experience level, profit in the deal, and the credit score of the borrower all will determine if the deal will happen. You can't have scenarios where you have zero experience, like the one I'm going to show you right here. But due to good credit and good profit in the deal, they'll do it. On the other hand, you could have good profit in the deal, no experience, not such good credit, and they're probably not going to do the deal, even if the borrower's credit may meet the minimum requirement. Remember, that's the minimum requirement, and then the other two components have to be taken into consideration. So I have two examples to share with you today here. The same exact scenario. The only thing that I did was just change the experience level of the borrower. So in this first scenario, we have 0 flips in the last 3 years. We have a purchase price of $115, rehab budget of $26,000, and an after repaired value of $210. So that's a pretty good flip right there. There's a lot of meat on the bones there. So the total loan amount on this deal is $112,250. That's going to include $26,000 for the rehab budget. So it's 75% LTV there is what they're actually lending the borrower. And you would just have to do the math and subtract, but it is 75%. And then total loan amount is $112,250, and total estimated liquidity requirements $36,163. And did I not put the rate on here? Okay. I may have forgot to put the rate, but it was 11.99% on that one. But the main thing to note really on this loan is just the flippers really aren't looking so much at the rate as much as what are they going to be able to get. And in the next example here, this one is 10.49% interest rate. So the rate drops 1.5%. But the main thing to note in this scenario here, now this investor has 3+ flips in the last 3 years. Same deal, same ARV, but the difference is the initial advance on this one is 85%. So there's going to be an initial advance at closing of $97,750. So due to the increased experience level of this investor with 3+ flips in the last 3 years, we get 10% more initial advance at closing. So our borrower has to put 15% down at closing. We're still getting $26,000 for the rehab budget funded. So we're funding 100% of our rehab budget. And the liquidity, total estimated liquidity required is $29,775.12. That's what they have to show in the bank. That's going to be for their expenses. So again, $29,775.12. It drops about $7,000. But the main thing here is our borrower is going to be able to get into the property with 15% down payment, 15% of the purchase price, and funding 100% of the rehab. So it's a win-win situation here for the borrower. And this is a much more cost-effective method of doing this rather than just putting it on your credit cards. Because unfortunately, if you put it on your credit cards, when you go to try to get that funding, or if you put a little bit on some smaller loan and rack up your credit cards, when you go to get that exit loan out of the flip loan and into the DSCR loan, your credit is going to be shot because your credit cards are going to be overextended, and then you may not be able to get the loan to value that you need to be able to exit this loan, and then you will either have to get a business partner to come in with good credit and hope that you can get the refi, or sell the property. So understand that these loans not only aid the financing of the rehab, but they also protect your credit so you don't rack up the balances on your credit cards, and then so that you can maintain your good credit score to have more viable options for the exit loan out of this one, and for the additional purchases that you want to do once you get your rehab and purchase money back, which is the idea, so that then you can repeat the whole process.
All right. Let's see. I don't see any questions here today. Great topic, though. Okay, let's go ahead and wrap it up then. We do this 11 a.m. Eastern every weekday, where we go through the live rates and do a deep dive into a different topic. So we'll have a new topic for you tomorrow. Thank you, everybody, for tuning in. Thank you, Jose. Great presentation. And we will see everyone tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.